Welcome to The Explainer. So today, we're dissecting the strategy of the world's most successful investor, Warren Buffett. Look, when you hear the term billionaire investor, you probably picture, a room full of glowing monitors, algorithmic high-frequency trading, exotic derivatives, maybe some heavily guarded offshore accounts, right? Well, scratch that. We are not looking at any of that today. Instead, we're diving deep into the refreshingly simple, almost agonizingly boring strategy he's championed for decades. It's a playbook that literally strips away all the noise, the flashy models, and those ridiculous fees just to consistently crush the so-called financial experts. Let's get into exactly how he does it and why this method is actually so incredibly hard for most investors to stick to. We just naturally assume the ultra-wealthy possess some kind of secret sauce to build their fortunes. I mean, the financial media constantly pushes this narrative that to truly win big, you need an edge, better information, smarter models, or a massive network of insiders feeding you tips right before the news officially breaks. It's that whole allure of exclusivity. But here's the thing. Warren Buffett has spent over 60 years proving that assumption completely wrong. The reality of his unprecedented success isn't rooted in overwhelming complexity or VIP access. Not at all. It is rooted in ruthless patience, absolute simplicity, and low-cost index funds. He's proven time and time again that the real path to extraordinary wealth usually means ignoring those exclusive opportunities entirely and just opting for the most basic vehicle on the market. When folks ask Buffett for his ultimate wealth-building advice, they're usually bracing for a hot stock tip or some complex macroeconomic prediction about interest rates. But his actual advice, it's way more profound. In fact, his most striking directive was literally written directly into the instructions for his own wife's trust. He explicitly wrote, put 10% of the cash in short-term government bonds and 90% in a very low-cost S&P 500 index fund, and he specifically name-dropped Vanguard. Just think about the context of that for a second. This was designed to protect his wife's inheritance from predatory, high-fee wealth managers after he's gone. The greatest stock picker in human history firmly believes that for the vast majority of capital, a basic, completely unmanaged index fund will easily beat out the expensive pros. Section 1. Inside Vanguard's S&P 500. Breaking down the VOO ETF. So the specific fund Buffett continually points us to is the Vanguard S&P 500 ETF, which trades under the ticker symbol VOO. And the main reason he loves it so much? Well, it all comes down to one powerful metric: $3. That's it. This fund charges a microscopic 0.03% expense ratio per year. To put that in perspective, for every $10,000 you invest, you are paying exactly $3 annually in fees. In an industry largely built on skimming 1 or 2% for active management, this is a total game changer. I mean, 1 or 2% might sound like pocket change, but over a lifetime of compounding, it acts as this massive anchor, literally eating up tens or even hundreds of thousands of dollars of your potential wealth. When Buffett preaches low cost, he means starving the middleman and keeping that compounding power entirely for yourself. And for that tiny $3 fee, you instantly capture broad, diversified exposure to America's 500 largest public companies across all 11 sectors of the economy. Plus, because this is a market cap-weighted fund, your money naturally concentrates in the biggest, most successful winners of our time. Right out of the gate, you're holding heavy hitters like Nvidia, Microsoft, Apple, Amazon, and Alphabet. As they grow in valuation, they automatically make up a larger chunk of your portfolio. You're not playing some guessing game, betting on a single horse. You are effectively buying the entire American economic engine in one incredibly efficient swoop. It completely removes single company risk while giving you full participation in the market's upside. But here is the absolute best part. This specific index self-corrects over time, and you don't have to lift a single finger. If a company in the top 500 starts to tank, loses market share, and drops in value, it just naturally falls out of the index entirely. And then it's automatically replaced by a stronger, hungrier competitor. No quarterly earnings calls to monitor, no balance sheets to stress over, and absolutely zero manual trades to execute. Thanks to this brilliant self-cleansing nature, VOO has averaged around a 15% annual return over the past decade. The real challenge here isn't picking the right stock. It's having the psychological endurance to literally do nothing and hold on through the rough patches to actually capture that return. Which brings us to Section 2, the power of doing nothing, the buy and hold philosophy. To see exactly how this philosophy translates to Buffett's actual multi-billion-dollar portfolio, we just need to look at how extreme patience and decades of time do all the heavy lifting. Take his legendary investments in Coca-Cola and American Express. Back in the 90s, he dropped $1.3 billion on each of those positions. But the crucial element to his strategy, he never sold them. Regardless of market crashes, dot-com bubbles, or severe recessions, he just held on. Today, that Coke position is worth roughly $30 billion, and it pays out an astonishing $704 million in cash dividends every single year. Amex, worth nearly $46 billion, generating $302 million in cash annually. These staggering valuations and massive cash flows were achieved through the sheer, unmatched discipline of doing absolutely nothing. The ultimate takeaway here is that human psychology is, frankly, our own worst enemy in investing. We crave action. We want to do something. But giving in to that constant temptation to trade, jumping between sectors based on whatever the news cycle is screaming about, trying to perfectly optimize a portfolio, that is exactly what destroys most investors' long-term success. The winning equation really is just time in the market plus low costs. Sure, it is completely devoid of excitement. It won't give you a thrilling story for your next dinner party or make you look like a financial genius to your friends. But by resisting the immense urge to tinker, this mathematical approach just works flawlessly over the long haul. Okay, let's move on to Section 3, the million-dollar bet. Active management versus the VOO. So, Buffett has always had a deeply rooted, very healthy skepticism of active Wall Street managers. And honestly, the hard data completely backs him up. The vast majority of these highly educated, highly paid professionals simply fail to beat the basic S&P 500 over a long enough timeline. Over a 10-year period, more than 85% of large-cap mutual funds actually underperform the S&P 500 after their fees are factored in. Stretch that timeline out to 15 years, and nearly 90% lag the benchmark. The reasons are painfully simple: high overhead costs, excessive trading fees, and plain old human error. Everyday investors are routinely paying luxury-level fees to pros who, statistically speaking, are going to end up losing to a completely unmanaged computer-run index fund. To definitively prove this to the world, Buffett orchestrated the ultimate financial showdown. In 2007, he put his money exactly where his mouth was, making a highly publicized $1 million wager against the wealth management firm Protégé Partners. The bet that a boring Vanguard S&P 500 index fund would beat their 5 hand-picked, highly exclusive hedge funds over a 10-year period. This was an incredible matchup. Wall Street's absolute best and brightest, armed with massive computational power and inside access, going head-to-head against a passive, low-cost index fund that literally anyone could buy in their pajamas from their living room. The final results? They weren't even remotely close. And remember, this specific 10-year period included the devastating 2008 global financial crisis. Despite that, the simple index fund absolutely crushed the expensive hedge funds, returning 125.8%. The highest performing hedge fund out of the 5 managed only 87.7%, and the worst one scraped by with a dismal 2.8%. So, despite Wall Street constantly telling us that active management is absolutely necessary to protect your capital during deep market downturns, the passive index still won by a landslide. Buffett proved his point flawlessly on the global stage, and he graciously donated his massive $1 million winnings to Girls Inc. of Omaha. So, we arrive at the ultimate question. If the world's greatest investor wins by keeping things incredibly cheap, buying the entire market, and having the sheer discipline to stay perfectly still for decades at a time, what justifies the constant tinkering in your own portfolio? Are you ready to set aside the ego of trying to outsmart the market? Can you tune out the daily financial noise and just let time and compounding do all the heavy lifting for you? It's a massive test of psychological endurance and emotional control, but as Warren Buffett has definitively shown us, it is without a doubt the most profitable test you will ever pass. Thanks for joining me for this explainer. Get out there and happy investing.